rates will rise, and we have had frenzied speculation as to when that might occur. Most recently, Mark Carney has indicated that the new normal by the end of 2017 will be that base rates come in at 2.5%, so a 2% increase. Now what that would mean is that the amount of mortgage interest paid across Great Britain would rise by a figure in the order of £20 billion, and it means that for every household on average with a mortgage, the additional interest they'll have to find each year is £2,360, a figure which rises quite substantially in London, where house prices are higher, to £4,000 additional expenditure every year. We have seen a period when house prices didn't do very much, but when they've come back and the growth has occurred, it's been quite rapid, particularly in London. And what you will see as interest rates rise is a squeeze on affordability, people having to find more money to service their mortgage, and that will act as a natural brake on house price growth. The issues are most acute, certainly within London, and that's where the interest rate rise will have the biggest impact, because house prices are higher, they've risen much more rapidly, and the nationwide index, for example, is suggesting that in the past year to the end of June, annual house price growth in London was as high as 25%. And London's been outperforming for a particularly long period, in excess of 9 years, outperformance across the UK. So that does mean that the level of house price growth which is left, the capacity for further house price growth, is much more reduced. And we've revised our forecast for London to have regard to the price growth which we've seen in the first 6 months. We've increased that to 15%, but what that definitely means is that there is much less capacity for house price growth over the period of the next 4 years, for example. Across the rest of the country, clearly much more capacity for house price growth, because you haven't seen the same extent of recovery that you've seen in London. And that means that an interest rate rise can be more readily absorbed in that market, and there is more potential for house price growth even in the event of that. But still, what you would expect is, as improvements, you've seen a big improvement in consumer sentiment, you've started to see an improvement in the economy much more widespread across the country, you would expect that house price growth to be highest in the next couple of years, and then as interest rates rise, you might see that slightly lower across other parts of the country as well. But generally, more capacity for house price growth. That very high pricing in London will mean that some people will migrate out of London into commuter markets, and perhaps beyond, particularly driving house price growth in those areas.